So remember how the housing market is bottoming out, so there's nothing to worry about as far as the economy and employment, right?
Residential construction is heading down, and it will continue to head down for quite some time. So very definitely a correction in activity in the sector.
Residential construction is faltering, but what's stopping infrastructure from coming to the rescue of the economy? Cranes on the horizon are seen as a measure of economic health, but cranes are rapidly disappearing along with lots of jobs as residential developers come under pressure. All hopes are resting on infrastructure to take up the slack and fill the coffers. But do we have the right workers to pull it off? Here's finance correspondent Philip Lasker.
It was residential construction to the rescue, driving job creation as the unprecedented mining boom ended. Now that support is in sharp decline.
Residential construction is heading down, and it will continue to head down for quite some time. So very definitely a correction in activity in the sector.
There are nearly 1.2 million jobs in the construction sector. Almost 1 in 2 of those workers are engaged in residential construction. The construction sector accounts for more than 9% of the entire workforce, so significant weakness is a major hurdle in the quest to get unemployment down.
It's also weighing on GDP growth as well. So collectively, the housing market downturn took about 0.3 percentage points out of GDP growth in the March quarter. That's really significant given the overall pace of growth.
Tighter lending standards have triggered a chain reaction. Banks aren't lending as much, leaving buyers with less spending power, so property prices have come down. Worse still, some buyers who signed up for apartments at higher prices now find the banks have cut back on the amount they're willing to lend. At the same time, there's a glut of apartments nearing completion, a hangover from the recent boom. It all leaves developers under increasing financial pressure or unwilling to embark on new projects, and that costs jobs. Now,
Oh dear, what could go wrong? Fewer cranes, fewer things being built, fewer people being employed who are supposed to go back to the bank and get a loan and buy some of those, if not all of those apartments being built. Another problem, too many of them. One thing they didn't mention here, and they keep forgetting to mention, is the foreign buyers. They ain't buying it. Then we got banks not lending as freely, as some buyers off the plan are unable to secure that mortgage that was previously pre-approved by the lenders. But hey, we are bottoming out.
That is relatively good news in terms of supporting the idea that the property market has stabilised.
And that was part of the same report, by the way. And then 2 days later, we got this reporting season.
And the bust in the housing market bit into Domain Group's net profit, which was down 29% to $37 million. Revenue was down 6.1%. The full-year dividend comes in at 6 cents.
So that was the Domain Group, domain.com.au, the real estate portal for residential, I believe, mostly. Profit down 29%. But we are stabilizing, you know. What about manufacturing powerhouses like Germany, or a lot more important one for us down here, down under, China?
We saw particularly weak Q2 GDP growth from Germany, printing a negative print. We also saw weak European industrial production and really, really ugly Chinese industrial production data as well. And that really means that we're starting to see now a bit of a synchronized global slowdown when it comes.
Seeing that our economy almost completely revolves around what happens to China as we continue to import or export iron ore and coal and other resources to China, while we were importing a lot of capital that ended up and found its way into the real estate, which is why we ended up dodging the last GFC, global financial crisis, back into 2006, 7, 8.
Really, really ugly Chinese industrial production data as well.
So should that continue and China falters, as it seems to be predicted, and going that way, we hit a recession with the rest of the world, and then the jobs go, and then who's going to be going and be able to go up to the bank and have those huge mortgages approved and repayments met? And now our favorite bank, the Reserve Bank of Australia, who say everything's A-OK, see what they say at the moment, and then see the reaction of my favorite person on the business on ABC is Michael Every. He is a financial market researcher at Rabobank. I think he's definitely not based in China, otherwise he'd be in trouble. He is in one of the Southeast Asian countries. I think he might be in Thailand, if not Hong Kong, or they might be too close, maybe Singapore. But stick around, have a look.
But here the Reserve Bank says we shouldn't be too worried.
At the moment, the US economy is actually growing above trend. So they've got a fair way to slow from here, but nevertheless, that is a risk, certainly.
And Dr. DeBell isn't convinced that inverted bond yields really do predict recessions.
I'm not sure I'd be relying on the yield curve as the best signal of that risk, given the yield curve has not obviously got the same sort of structure that it's had historically.
What he just said there actually doesn't make sense. He confused himself. His thoughts weren't there. So he said something that he just couldn't explain to himself. It absolutely doesn't make sense. Re-listen it if you need to. Now get the popcorn. Like I said, my favorite guy is on. I have had a recent video on him that is titled "What You Really Think About China: A Brutal Truth." A very good viewing. I didn't post it that long ago, so take a look. Actually, I'll put a link below. And now here's what he thinks about the Reserve Bank of Australia.
Well, as we just heard, the Reserve Bank Deputy Governor Guy DeBell is downplaying the crisis unfolding on global markets. But leading economist and global market strategist Michael Every says Guy DeBell is the last person we should be listening to. Mr. Every believes the bond market is telling us we're in deep trouble.
Well, yes, I think we should. And if there's anything we shouldn't be paying any attention to, it's the Reserve Bank Deputy Governor. And, my quip would be, ask not for who DeBell tolls, it tolls for thee, because he's talking absolute nonsense. If you want one example of why that's nonsense, every single time that the Aussie curve looks like it's starting to invert, the RBA cuts rates. So they may be saying it isn't sending any kind of signal. They act on it themselves, ergo he's talking nonsense.
So do you think that the US is heading for recession? And if so, what preparations do we need to make apart from just selling everything on the share market?
Well, let's not rush in and sell everything. There is opportunity in a downturn. You don't have to immediately just rush to sell. Our house view is, yes, there will be a US recession next year. That's pretty much baked into the cake. And one of the reasons why everyone's panicking is that the bond market sent yet another signal yesterday that is what it expects to happen in the future. It was already our forecast. It's been confirmed by that particular market indicator. Now, of course, the RBA are going to say she'll be fine because that's all the RBA ever do. And if you look at where interest rates in Australia are now compared to where the RBA said they were going to be at this point, which is where they were in January or higher, you can see just how credible the RBA is and just how little time we should spend listening to it.
We kicked off overnight with big selling because of some disappointing data out of China, a continued slowdown in German data as well. How concerned do we need to be about these 2 points?
Well, concerned about both. It's not looking too good anywhere you look. China is still growing, but it's definitely growing more slowly than it has been for a very, very long time. And there's no likelihood of it accelerating on a sustained basis. You may get the odd quarter or two where it picks up, but the trend is going to be down and down and down. And Germany, well, really in a real sticky wicket, to be honest. Auto production is lower now than it was during the financial crisis, which tells you something. And that's even before we hit any speed bumps ahead with things like Brexit or that US recession that we're already factoring in. So Europe's looking pretty ugly. America's looking pretty ugly. China's also looking not too pretty.
What makes you so sure that the US is going to hit recession? You've got the president applying plenty of heat to the Federal Reserve. The Federal Reserve does have room to cut rates. Why so firm on a recession?
We have a complex internal model that looks at a variety of different factors, one of which is the yield curve, which is why everyone has been panicking about that yield curve inversion that we've just seen. But you have to understand that the main mechanisms that you have for preventing a downturn are, number one, monetary policy, which is move interest rates lower, and they seem to be very slow in acting on that, which is one of the reasons why Donald Trump is shouting at them so much. And number two, fiscal policy. And on that front, really, they've used up most of their bullets already in the tax cut that they handed out last year. So they haven't got a great deal left in the tank. And then on top of that, of course, if you add frictions from the trade war and a slowing global economy, because everyone's linked together, it's pretty hard to be optimistic and upbeat.
And so, I mean, you've been pretty critical of the RBA. What should the RBA do in this? Are we going to continue to cut to zero?
Yes, you will, which is, of course, what the RBA keeps saying they're not going to do. In January, they gave no indication whatsoever they were going to be doing that. But that's what they will do. And then after that, I strongly suspect they'll do some form of quantitative easing, or QE, as we call it in the markets. I would imagine they'll be buying mortgage bonds, possibly government securities, if the government actually starts spending more money into the Australian economy to try and support it, which would be a very good idea, by the way. But, Canberra doesn't appear to be listening to that either.
Michael Every, thank you so much for your time.
You're very welcome.
Very well. Good for you, sir. I'm a big fan. And before you start thinking, if everyone's saying, and even the guy that we supposedly trust and follow, like Michael Every, saying that the global economy is going to blow up, don't think that that means you should turn away from the share market or any other investment and then just buy property, because during these times property somehow keeps going up. That couldn't be further from the truth, because once the recession is around, and if that does happen, fewer people will have jobs, be able to get loans, and if anything, real estate will drop a lot more than the value of your stocks on average. Because while the share market seems fully priced, if not slightly overvalued, the real estate market is an absolute out of control bubble. So my strategy is going to be to try and keep as much cash as possible, and when the opportunity arrives, maybe get into the stock market, because that's again fairly valued, but far from a bubble, because bubble dictates for a lot of retail investors, meaning us, me and you, mums and dads, to be invested in it. Now we know that everyone's got the money from wherever they could and got as much leverage and loans and mortgages to get into the property, whether living in it, fair enough, or investing, which means that mums and dads, you and me, are fully invested in property, meaning that's the only way to have a bubble, which means it is a bubble, where very few of us are deeply in a share market, which means it's definitely not a bubble, and it's got a long way to go. Again, not before it supposedly maybe corrects in the next 6 months or so. Just my current opinion, if not wishful thinking, but we'll see how it goes. That'll do it for this 18th of August. Thanks again for watching, and we'll speak again soon. Take care.